afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. These are the top headlines that we're tracking at this hour. Markets continue to remain weak and heading into final hour of trade. The Nifty has bounced twice from levels of 11,300. The Bank Nifty is underperforming the Nifty today. The HDFC twins are witnessing their biggest intraday fall in over 9 months. Both the stocks are contributing to over 90 points fall on Nifty today. There is no respite to the correction in auto stocks. 3 of the 4 Nifty stocks hitting 52-week lows today are auto companies. Kotick Medra Bank will be the only Nifty company reporting earnings today. The bank is likely to report a strong quarter with a stable asset quality. The stock, however, trades weak ahead of the numbers. And Chandrayaan 2 will lift off from the Satish Dhawan Space Center in Sridhara, Kota in just a short while from now. Good afternoon, Neeraj. Well, the selling pressure is just intensifying. Third straight day of sell-off.
Yeah, and all fingers crossed for Chandrayaan, of course. Once bitten, twice shy, but we hope that that goes ahead. But yeah, and only you're right. I mean, that sums up really the day's action. The selling pressure, and it's only intense. Frankly, there's no other way to describe this. The large caps are down about, well, Sensex is down about 1%, the Bank Nifty down about 1.7%, so it's not looked all that great. And the market breadth should come up on your screen as well. I'm sure that is not looking all that great either. 1:4 or 1:3 in favor of the declines. Pull up the heat map and show you what's moving and what's not. There is losses for the Bajaj twins, HDFC Bank. When was the last time that you saw this? That the Bajaj twins and the HDFC twins are 4 of the top 5 losers. You don't normally see that. And contrarian to that, Yes Bank is up about 5%. It's just the nature of the markets today. Z Entertainment up 3%, Indiabulls Housing 3%, Maruti 2.5%. So there is pain on the screen. There are some stocks which are bucking the trend. The breadth may actually seem positive, but that's the nature of the market today, that while the Nifty 50 has more gainers than losers, the heavyweights are correcting, the HDFC twins are correcting, and that's putting that pressure on what the Nifty Bank as well as the Nifty. The broader markets too, but not quite like the Nifty when it comes to the breadth.
Yeah, it's worse off, and we've seen that in the last whole week. And last week, while the Nifty was down about 1.2%, the mid-cap index gave off a hefty 2.5%. And that's probably the case as we start off this week too. You are seeing a lot of pressure building up in the mid-caps and the small caps. I'm going to start off first with some stocks that have reacted on the back of numbers. So L&T Finance Holdings, that stock disappointed the street on its numbers and is down about 3% since the morning session. Mahindra CIE, a heavy knock of about 7.5%. From the auto anchor space, Amar Raja Battery did not disappoint, and therefore in a falling market has managed to hold for is up about 1.8%. Other stocks on the move, we've got Spark, that's Sun Pharma Advanced Research, is up 6.5%. And what a run has this had in the last 1 week on the back of what the upgrades were for Sun Pharma. This one has really managed to do well, and in today's session also holds tall. Avanti Feeds on the numbers is up about 8%, and Dish TV also from those lows is picked up and now at about 33.5. Other stocks on the back of some volumes, Interglobe Aviation for one is doing okay for itself. The performance was one of the highest that we've seen for Interglobe Aviation. You've seen the air traffic numbers as well. They've not done badly in terms of passenger growth. I think about 20-25%, not as much as compared to SpiceJet, but they've done well, though they have ceded some market share to SpiceJet in the process. InfoEdge is the other one. That stock is trading with good volumes. About 1.8 lakh shares have been traded there. And SAIL from the metals pack is up about 3% with about 1.3 crore shares that have been traded. Other losers include the likes of Indiabulls Real Estate, Minda Industries, and Zensar Technologies, and stocks which are trading near their 52-week lows in a falling market. The list is quite long, but M&M Financial, that stock makes a 52-week low at about 351, so just a smidge away from there. EID Parry is at 160. Its 52-week low is about 158. And Maharashtra Seamless, which is down about 4% at 410 right now, its 52-week low is somewhere closer to 406. So we'll wait and watch as to whether they manage to make that low today or no. But Nonetheless, it's also important to keep an eye on what's happening in the F&O space. There's more liquid universe, more trades taking place there. Navneet is going to highlight that for us. Navneet.
Thanks for that, Davina. Well, not a great start to an all-important week. Remember, this week will mark the expiry of the monthly contracts as well. So just to recap how we've fared so far for the July series. By the way, as of now, this is turning out to be the worst series of this calendar year. Nifty is down about over 4%. Bank Nifty has seen correction of about 6.5%. And the broader markets, as we've been seeing market breadth worsening every day. So that has actually underperformed, down over 8%, and that's the Nifty Midcap 100 index. And markets are heading lower, but if you look at the open interest, how we started the series for Nifty, we started the series at open interest of 1.8 crore. The current is at 1.5. So open interest has fell about 16%. That's telling you that the traders are actually unwinding their positions with markets coming off. No fresh positions are being created at current levels. And similar is the picture, by the way, for Bank Nifty. The series started with open interest of about 17 lakh shares. Current is at 15 lakh shares. Open interest has declined about 12% so far. So for markets to bounce back, remember, you also need some short positions in the system for a short covering bounce. Let's see if that comes by or not. In terms of options data, what sort of level can one watch out for this expiry on Thursday? Maximum open interest on the call side, it is at the 11,400 call. On the put side, it is at the 11,300 put. And both these strikes have been very, very active. As you can see on your screen, 29 lakh shares have been added for 11,400 call, premium of about 35 points. And for the 11,300 put with premium of about 38 points, almost 13 lakh shares have been added. If you club the premium, it's giving you 80 to 85 points, and that's the range probably you can work from current levels if somebody is doing a short triangle on Nifty for the expiry. 11,250 to about 11,450 can be the range to watch out till Thursday. Stock futures, I have to mention the Bajaj twins. It's not every day you see such a sharp decline. Both the stocks have fallen for the second straight day, but particularly on the future side, it is with Bajaj Finserv where open interest has surged significantly. That's up 15 to 16%, telling you there are shorts being seen here, 5% lower for the company. And the other heavyweight with almost 10% weightage on Nifty, HDFC, which is trading very close to its 50-day moving average. Fresh short positions have been seen here as well, as the open interest for this stock has surged about 16%. Interglobe Aviation, good set of numbers coming by. The stock's up on high volumes on the cash side, long position seen on the future side. The stock's been trading above its 100-day moving average, and that's the AV80 function of Bloomberg. The white line is projecting today's volume vis-a-vis the average volumes of last 20 sessions. When the stock goes up on high volumes, it's definitely an encouraging sign for the stock.
Okay, let's talk about the world at large, because that's in focus too, or what with the Fed meet slated to happen soon. Skirmishes between UK and Iran leading to crude oil prices moving up. Lots of volatility, as is always the case. Michael Ingram, independent market strategist, joins us right now on the show. Mike, good having you. Thanks much for joining in. We're not at highs, but almost there. We have a fairly important Fed policy coming up, and the news flow surrounding earnings or otherwise isn't the strongest. How do you expect the mother market, the US, to do? And in light of that, what would the other global markets do?
Good afternoon. Well, I mean, markets and the global economy is really treading something of a tightrope at the moment. On one hand, you know, if you look at the sort of forward indicators, it's very, very clear that you know, growth momentum is weakening. Whether you look at you know, container traffic on the west coast of the United States, whether you look at new export orders in China, or indeed South Korean trade data, it's very clear that the global economic growth is slowing, and you know, trade and manufacturing remains very much in the eye of the storm. On the other hand, as you've alluded in your preamble, you've had this significant resurgence in monetary activism by global central banks. I would point out that the Reserve Bank of India has been perhaps one of the most aggressive cutting in cuts and easing thus far this year. And of course, we're expecting further measures from the ECB on Thursday and the Federal Reserve on the 30th of July with a quarter point cut there, absolutely discounted by the market, and much more for the rest of the year. I think the question is to what extent is who's going to win this race, because as I've mentioned, thus far the fall has been largely contained to manufacturing. It hasn't really impacted the consumer to any real extent, and that's why you've got this disconnect between manufacturing and service PMIs at the moment. The question is if you have continued uncertainty, if you have continued trade disruption between US and China, to what extent is that going to feed through into weaker investment? You're already starting to see that, and eventually weaker employment prospects, and then the consumer starts to wane, and then it doesn't look very great at all. At the moment, I think the risk markets, looking pretty febrile. We've had a very good run thus far this year. Yes, the Fed's going to help, but we've come a long way. And my own feeling is we're in that part of the year now where volatility can often pick up. Markets are becoming illiquid in the summer season, and I would be quite wary about loading up on risk ahead of the Fed, particularly since so much is already discounted in that market.
Michael, how closely are you tracking corporate performances? Because, not just in India, but I believe, earnings season across other emerging markets, across the US, have proved to be slightly more disappointing this time.
Yeah, I mean, I'm always a little bit suspicious about, looking at the current earnings season, because there's always to some extent, a bait and switch game going on. Analysts tend to cut into the print and then say, well, there's a positive surprise. I think it's quite telling that we are, seeing at best a stabilization of rolling forward estimates. So whether it's 12-month forward, 24-month forward estimates, we have seen those in developed markets come down, EPS come down by something like 4%. In emerging markets, it's closer to 10%. Now, there has been a flattening out of that. Sorry, that's so far this year. So you have seen a bit of a flattening out of that trajectory, but you're not seeing much of a recovery at the moment. And I think to some extent, perhaps the reason why institutions on balance are taking perhaps a mild O-weight in emerging markets is they're taking a view that, despite the earnings deterioration, the earnings momentum deterioration, the market's still relatively cheap, and also the currencies are relatively cheap. Of course, if we are going to see this significant resumption in monetary activism, the Fed cutting, the ECB cutting, Bank of Japan seems to have jettisoned its inflation target completely, then that is an environment which is quite kind to carry. But as we may see later on this week, on Thursday, with the central bank in Turkey, I suspect they'll be encouraged to cut too far, and of course, then you'll have another panic around the Turkish lira. So yes, there is scope for central banks to cut across emerging markets. That will be supportive, generally speaking, of emerging market assets. But we also have to look at external vulnerabilities, and I've mentioned Turkey's an obvious outlier there.
You spoke about, the yields coming off, and do you feel that most of what we're seeing in terms of what's been happening to yields globally is already factoring in, what the Fed has done in terms of its commentary, or even for us here in India, we've seen, multi-quarter lows in terms of the yields out here. So in that sense, it's already baked in, and from an investment point of view, if someone was to look at probably shifting some money from equity into the bond markets, it actually may not be a wise decision.
Yeah, I mean, I think if you look at what the most recent institutional investor surveys suggests that perhaps U.S. Treasuries is looking like a rather crowded trade, and of course, we are off the lows in terms of yields on the 10-year now, and yeah, you're right. I mean, there is so much already baked into rates markets. Yes, people are bearish on the global economy, in terms of sentiment. We're back where we are, but we haven't seen this sort of level since like 2009. Great financial crisis kind of territory. Having said that, U.S. 10-year at around 2%. I mean, that's pretty gloomy, and in terms of rates, the market's discounting effectively 3/4 point cuts this year, which to me seems a little bit excessive, even though Chairman Powell might want to frame it in terms of an insurance policy. I think if you look at where institutions are largely positioned at the moment, they tending to be underweight equity, but still positioned within growth. They're overweight the US, they're overweight emerging markets to some extent, and underweight Europe and certainly underweight the UK, most hated equity market perhaps in the entire world. But overweight fixed income. But as I say, they're a little bit worried about that. But also overweight credit. As I mentioned, it's back to this idea about carry. Credit has been quite well behaved, and overweight cash. So it's a bit of a barbell as far as I can see in terms of portfolio disposition. But make no mistake, I mean, everybody's nervous. Trump remains a wild card. We're just one angry tweet away from a market retreat. And as I said, we're in that time of year where the liquidity is evaporating quite quickly. So some of these moves might be quite sharp. So frankly, I'm quite surprised that implied vol on the VIX has been quite as low as it has. Particularly bearing in mind as if you look at the MOVE index, the implied vol on the US Treasury strip, I mean, that's still at relatively elevated levels. So the one thing I'm reasonably confident about is that we're probably going to see more equity vol in the next few weeks.
Michael, before we wrap this conversation, do you see any sort of shift in fund flows between China and India at a time when China seems to be opening up its economy for FIs, and back home there seems to be some bit of conundrum because we've seen outflow from the FI community in the month of June post the union budget, where higher surcharges being levied for the FIs which are registered as a non-corporate. So do you see that happening in the coming days?
Yeah, I think it's quite likely. I mean, really, investors would like to buy China and on the back of that sell India. But I mean, there is still not a great deal of visibility in terms of the the relative momentums of those economies. And also, I mean, you mentioned China actually opening up. Well, yes and no. I mean, we did see China effectively limbo under the capital requirements for being included in the SDR. Special drawing rights in the IMF, but since then it's introduced a number of capital controls, both formal and administrative. So I wouldn't necessarily say that for portfolio investors the environment has actually improved over the last 3 or 4 years.
Okay, Mike, we'll leave it at that. Thanks much for taking the time out and giving us that perspective.
Pleasure.
Well, that's the view from a global voice. Now let's talk about the space that is in focus. HDFC Bank, HDFC, the Bajaj twins, they are the stocks that have corrected big time. An expert who tracks this space very closely to join in and talk about the commentary that has come out from HDFC Bank on the unsecured book and others, the implications of all of this. Siddharth Purohit of SMC Institutional Equities joins us on the show. Siddharth, when was the last time you saw HDFC Bank and HDFC, as also the Bajaj twins, being the 4 of the top 5 losers on the Nifty? Is it the commentary from HDFC Bank that has spooked these names?
Yeah, hi. In fact, there are a couple of factors I would try to highlight that, first of all, the commentary certainly that there has been some amount of cautious statement from the bank if you look at in the last couple of quarters with regards to maybe asset quality and also with regards to growth. So when you talk about growth, certainly there is a moderation in their core business, that is the retail lending, and particularly some of the unsecured business and also auto segment. But let us understand that, the market itself in that space is going through a changes. There is a sharp decline in auto numbers, and the consumption numbers are not giving any sort of comfort that, there will be any pickup. So it is quite evident that, HDFC Bank also, being the largest, retail lender, will try to moderate their growth. So there is nothing wrong in moderating their growth. But only point is that, probably there has been some amount of stress, little bit of incremental stress on the unsecured book also. That is what they have tried to highlight during this quarter. And that is what the market is predicting. But my personal opinion is that probably it's a right move by the bank if at all they try to moderate the growth when the environment is not good. So probably you might see the moderation in loan growth for the auto and unsecured for a few more quarters. And that is probably taking a toll on the stock. And as you know, probably HDFC has always been valued at a premium compared to any other bank. And now that moderation is in growth is visible, so probably market is a bit cautious and there is some profit booking.
Okay. Siddharth, we've seen these stocks correct. We've seen these stocks being, holding such amount of premium because of the name that is attached to them, Bajaj Twins, be it HDFC Twins, and for the lack of any other better investment opportunity, the premium that an HDFC Bank holds of 3.72 times price to book was justifiable up until now. But after the kind of forward-looking comments that they have made, which have alluded to some amount of risk being there in the foreseeable future, do you think that risk premium that is being awarded to these kind of banks will start to come off?
I really don't think so. See, the problem is that, there is a moderation in the entire industry. It is not specific to HDFC Bank. Now, when you talk about moderation in the entire industry, certainly the best player will probably have the highest growth. And I would rather be more apprehensive about the banks which are trying to outpace the industry growth rate than and I would rather go for banks which are trying to moderate their growth and balance the asset quality. So there will be some amount of valuation concerns in the medium term. But if you look at if you look at the long-term average valuation of the bank, even if there has been some moderation, it has never traded below that 3 times forward book. So there might be some moderation in the near term, but I believe that they warrant HDFC Bank warrants a higher valuation. And I would rather be worried about those banks which are still trying to outpace the industry growth rate rather than HDFC Bank, which is still growing 17-18%, which is fair enough, I believe. And with one more point which we are trying to highlight is that, the NIM. NIMs will certainly be a concern, little bit, because the high-yielding portfolios like auto and personal loans, credit cards definitely are NIM accretive. If you see some moderation there, certainly there will be a NIM dip. But that will be a temporary blip, I would say. So I am not over cautious on the bank. And if I, in packing orders, if still, if you ask me, then HDFC still happens to be a very good stock. And there has been a good amount of correction also. So almost 10% corrections recently. So I think maybe 2-3% more corrections and then you'll find value buying in that. So I'm not really worried about any de-rating in the stock as such.
Well, and they continue to be the torchbearer, at least of the banking industry, with 20% CAGR earnings, 20% consistent dividend payout, and with 17% ROE. So that one number which could be a worrying sign, and of course we've been discussing that, the loan growth was about 17 to 18% versus 24% which was seen in the March quarter. Do you foresee the loan growth now for the entire financial year, and the sort of cautious commentary that they've given to the retail side of the business, which forms nearly 50% of the loan book, could fall sub 20% for the entire year?
Yeah, probably will see that moderation in growth for the entire year, and that 17-18% would be ideal growth for FY20. Probably FY21 you'll see more pickup because as you rightly said, auto and this personal loans and CV all has taken a toll, and 20 you should not expect more than 17-18% loan growth. So and that moderation is reflecting in the reaction in the stock price. But I feel that, your 17-18% growth when the industry is growing by 12% is, by any standard, not bad. When the asset quality has marginally deteriorated, but is still not alarming enough to call for any sort of de-rating. So I'm still positive and hopeful of HDFC Bank being a strong player going ahead. And not really concerned too much about the valuation de-rating as such. There will be some amount of profit booking and pressure in the stock in the medium term, but absolutely not a point to sell up the stock and switch over to anything else at this point of time.
Well, that's been the call, Siddharth, of majority of the brokerages who still maintain their rating on the buy side. Appreciate you joining us today and taking us through your views on HDFC Bank's numbers and what to make of the commentary, the cautious commentary given by the bank. For the first time, highlighting that the consumption slowdown could impact the retail book of the bank. 2297 is where the stock's currently trading with cuts of over 3%. Moving ahead, the government's decision to include shareholding of other state-run institutions in any listed company may restrict these institutions from selling their stake in these companies. Nikunj Ohri is standing by to tell us why. Nikunj, it limits the scope for companies like LIC to sell their stake in these companies?
Right, LIC and other public sector companies holding stake in other public sector companies may not be able to sell their stake or exit their stake in companies where the government intends to lower its stake below 51%. Such companies as well as LIC will not be able to sell their shares to maintain an agreed upon threshold which will be decided by the Union Cabinet and may have to limit their holdings to that agreed upon threshold. The government is also going to conduct consultations with LIC and other public sector companies to get to know their investment plans and then may decide a limit or a threshold through which the government will reduce its shareholding in public sector companies. Remember, Finance Minister Nirmala Sitharaman in her budget speech has said that the government will bring down its shareholding in public sector companies to 51%, which would be inclusive of stake or shareholdings of government-backed institutions. Now, some of the companies in which the government currently holds close to 51% stake and may bring down its stake further are Bharat Electronics, NTPC, BMEL, BPCL, Indian Oil Corporation, NALCO and other companies in which the government may bring down its stake, and these companies were also removed from the CPSE ETF as the government shareholding was closer to 51% were Engineers India, Moil, Container Corporation of India and GAIL India. Over to you.
All right, Nikunj, thanks very much for that quick update coming in there. We'll keep track of any further details that come about. But moving on, Ashok Leyland has started a pilot project to ply electric buses in Ahmedabad. Yatan Mota spoke to Karthik Atmananthan, head of electric vehicle segment at Ashok Leyland, and started by asking how EVs stack up against diesel buses and how Ashok Leyland sees the EV business panning out. Listen in.
Right now, the financials do not stack up against diesel. So there's a government grant for government buses. So there is, fiscal subsidy sense that's brought into using these. 3-4 years down the line, we are expecting quite a lot of the market to see diesel cost parity. Between electric and diesel, there would be similar total cost parity, not upfront costs. They'll always be higher for electric buses. But if you look at a 7-year total cost, our estimate is by 2024, there will be cost parity with diesel. And that's when the actual market will take off. Till such time, it is enabling the ecosystem by the government. That's how it is. So we will keep coming up with products as and when market starts pulling. Right now, we are focusing on core technologies, skill building, reliability, designing for India, tropics, etc. So the tech part, internally, there's a lot of aggression. Ashok Leyland, in the market, we are not very aggressive for electric vehicles. We see that quite a bit away.
I'll hold the mic for you. If you can also talk about the pilot project that you're doing for the Gujarat government for Ahmedabad, how does the project work? Because I believe that the average travel would be 200-250 kilometers. There will be intracity buses also from Ahmedabad. So how really are you maneuvering in terms of range and in terms of product? Because every state in India has a different terrain. So how really do you design your product? Will this be an initial pilot in which you will be test marketing, or are you ready for other states as well in terms of bidding for new contracts on the electric vehicle front?
No, see, even within a city, the routes are so different that you will need different solutions. In some places, you can manage it by swapping batteries, and each battery will take the bus only for about 35 or 50 kilometers. In other places, you will have about 100, 120 kilometers range. In other places, you might need to give a total of 250 kilometers range. So this is dependent on the route and the schedule. So the idea is to take care of the schedule and have a flexible product configuration, which is modular, both in architecture as well as in energy management. And you keep upgrading, or not upgrading, you keep offering different solutions for different routes. So we have these technologies proven, they are running in Ahmedabad. So we are participating in the FAME 2 tenders, but as an OEM selling buses to operators, and we are expecting operators to actually sign the contract with the state governments.
In terms of participation from private players, we are talking only about government business at this point in time from electric vehicle, because probably government is the largest fleet buyer in the marketplace right now. In terms of private bus operators, in terms of private parties participating in the electric vehicle segment, how do you really see that business segment shaping up? Do you think right now it will be dominated by government, and gradually as the technology picks up, costs come down, there will be more participation from private fleet operators and private bus operators?
Exactly. What the FAME 2 is doing is enabling the ecosystem. It's driving costs down, it's implementing supply chains. So FAME 2 is driving the ecosystem. This is the first step. So over the next 3 to 5 years, what will happen is the costs will come down. And once there is diesel cost parity, there is very little reason private sector will not move to electric, because it now makes more money sense and it's more reliable, quieter. So it is a matter of time. Of course, long distance buses, the technology solutions are still not fully in place. But up to 400 kilometers per day, there are enough solutions. So these will be able to click by 2024 when the mass market will start. You should remember that a big chunk of the bus market is actually staff and schools transportation. Right. That doesn't run more than about 100, 120 kilometers per day. Okay. So the advantage is range is not a problem. The disadvantage is they run so little that they cannot achieve diesel cost parity very easily. Okay. You achieve it by running more kilometers. So they will be the last to arrive. Right now, it looks like anybody who does 200, 250 with subsidy, it's going to make sense. Later on, for 400 kilometers, it might make sense without any subsidy.
And is it easy to convince a financier at this point in time for electric buses? Because right now the commercial vehicle market is facing the heat because of the NBFC situation. For electric vehicles, there are a lot of challenges. We still don't know about the technology, how good it runs, how good the economics work. So is the financier also slightly skeptical about the electric vehicles, or you are finding it easy to finance such orders at this point in time?
No, financing for our operators is not yet in place. And it's not because it's not viable or safe or whatever. It's just that the finance sector is not engaged enough. That's one of the reasons why I'm here today. This finance sector now needs to engage, get itself educated and enter the space. There's money to be made with financial products. So I think it's a matter of time, but the finance sector needs to get engaged. It's a small opportunity, not as big as the diesel market, but still there is enough and more. So we expect the finance guys to get engaged over the next 6 months when contracts pan out.
In the budget, we had a push from government for the electric vehicle side. Of course, there is demand in the marketplace. How soon can you ramp up, in terms of capacities and in terms of vendors? Of course, the product is slightly different. Of course, the body and a large portion of the bus remains the same versus a traditional ICE engined, vehicle. But in terms of ramping up the capacity and getting the products delivered from the vendors as well, so that you can assemble them quickly, how confident are you on that front?
See, we are right now at Ashok Leyland, we are equipped for 8 per day. And we believe that it's enough for the market now. As and when it goes up, we will make it a more mature or higher capacity supply chain or production line. But for what is out there in the market, I think we are well equipped for now. This is in Ashok Leyland. But remember, there are many more players. So all of us have enough capacity.
All right, that's the management of Ashok Leyland talking about their EV plans moving ahead. Shifting focus back to markets, and weakness continues. Nifty is right now sitting with cuts of about 90 points. Bank Nifty down about over 500 points in trade, 29,250 is the level where Bank Nifty currently trades. Good time to bring in our technical experts and get their view on the markets. Hemen Kapadia of KRChoksey is joining us right here in the studio. We also have Ajit Mishra of Religare Broking. Good afternoon to both of you, and thanks a lot for joining us today on Bloomberg Quint. Hemen, let me come to you first. We've already corrected a lot in the last 3 sessions. At current levels, would you suggest people who had gone short to book profits now, or does this also give you an opportunity to create new positions?
Yes, I would have cut the shorts last hour because we made 2 attempts in the last 4 hours and we haven't gone below 11,300 in the Nifty cash. So I think that seems to signify some resilience. Is it enough to go long? I'm not sure. But coming back to the main question, yes, I'd cut the short. So I think we're setting the stage for a small bounce. Sustainability suspect, but yeah, I'd cut the shorts.
Okay, cut the shorts is the advice coming in from Hemen. Ajit, what about you? Would you take any position on the benchmark indices right now, Nifty or on Bank Nifty?
Hello, Devina. So basically at current levels, I would prefer to avoid any fresh long or short because we have already seen a decent correction in the recent past. So I'll wait for any pullback. Definitely the bias is in the negative side, but 11,300 is a very crucial support and Nifty is respecting as so far now. But on the other hand, the Bank Nifty still have room on the downside. So yes, the bias is still on the negative side. So I'll use any rebound to go short later on, let's say 11,450, 460 levels for Nifty to go short with 11,600 is a stop loss and 11,300 to 11,100 is the target.
Okay, let's keep it to some stock ideas then, Ajit. We'll stick with you.
See, at current levels, we are seeing mixed trend when it comes to stocks because we are in the earnings season and talking about the positives, Power Grid has been showing exceptional resilience at the higher levels. After retesting the record high of late, it's still holding in a consolidation range. The bias is in the positive side. So one can consider fresh longs around the current levels with 198 as a closing stop loss and 216 as a target. On the other hand, we have seen a kind of strong resilience, strong resistance in the Tata Chemicals at the higher levels. It's failed to sustain above 200 EMAs after making twice 2 attempts in recent past. So we may see some consolidation, but followed by a sharp correction in days to come. So one can go short in Tata Chemical as per the recommended levels.
What about you, Hemen?
Yeah, I think I'll be brave enough to suggest long positions. I have a buy call on MCX. But the thing is, MCX has already moved since the time I gave the call, Devina. So I would wait for a small decline, not a complete decline. It was supposed to be at 860. Now it's already moved to 878 in the past 1.5 hours, and we are at 872. So I'd wait for it to come off to 868 or so. 10 rupees stop loss, 20 rupee target. I have a buy call on Engineers India at 107, stop loss 104.50 and a target of 112. And lastly, I'd sell the 11,000 put option. I don't think we're going to 11,000 before we give a 150 point
That's
bounce.
a long way away, sir. It's still a long way away, 11,000.
Yeah, so I'll sell the 11,000 put next month.
Okay.
Because there's no premium left in this month. I won't wait for the whole month. VIX has gone up to 13. I think the VIX will go to 14 as we tank further. So next month, 11,000 vanilla put selling. I think it's safe because there's a bearish gap today in the daily chart, which I think in the next 72 hours should get covered up, or we'll make a sincere attempt at covering that up. So we'll make some decent money in this put.
Okay, got that. A few other stocks, and since we were talking about the HDFC twins and the Bajaj twins, a quick word, Ajit, on HDFC Bank and on Bajaj Finance today. What would the trade look like if you had to take one?
Devina, today we are seeing pressure in banking space largely due to the HDFC twins and after the kind of decline that we have seen in HDFC Limited. I feel that the next leg of decline in the Bank Nifty could be for the reason because we have the other twins like Bajaj Financial and Bajaj Finserv result also scheduled this week. So this negative bias, which we are just discussing, that Nifty could extend further decline from the current levels, it largely due to the banking stocks. So I feel that it's best to avoid any fresh long position at the current levels. Rather use any rebound to exit in case if you have any, and or you can initiate bear spreads rather than initiating any fresh naked position, both SDFC twins or Bajaj Finance twins.
It's interesting the way these stocks have corrected, and the question mark only is that at what point of time will people believe that these expensive valued stocks as well have corrected enough and may not go down to the valuation at which some of the other stocks are there, but have corrected enough for us to go out and buy. Let's see. Let's wait and watch. Meanwhile, the others like RBL Bank and a few others continue to slide lower, and that's the problem part. The stocks which have corrected thus far do not see any signs of bottoming out. We'll get in Dharmesh, Kant in moments from now and try and talk more about these. But just one quick follow-up on a banking name again. It's too much of banking, Hemen, but Yes Bank, very curiously, is up about 6% purely from a trade perspective. Would you believe that somebody long here should continue with the long positions?
I think so. It's like it's been completely overdone. In fact, if the decline continues and Yes Bank still holds on to the 80 level for the next 10 days or so, I think I'd look at Yes Bank from a positional point of view. It'll give you 50% return in the next 1 year.
Wow. Well, let's wait and watch. A few things need to happen, but yeah, Hemen is right. He's looking at the charts and saying that maybe the correction was overdone and maybe some upsides out here could be warranted. Dharmesh Kant of IndiaNivesh with us on the show with his thoughts. Dharmesh, good having you. Thanks much for joining in. HDFC Bank and Bajaj Finance, the two poster boys, banking, NBFC, both of them are correcting. Would you believe that the correction would last, or would you believe that shortly some money would start finding their way in?
Yeah, good afternoon, Neeraj. No, I don't think it will take time before some money, starts finding them and being deployed in either HDFC Bank or Bajaj Finance. So we are here. I mean, the correction is here to stay, and the market will slide down further. Though we may be near our intermediate bottom kind of a thing, but my point is. Not about correction being stopping. My point is, what are the triggers which are going to take the stocks up from here? So the visibility of revenue or earnings which you see, whatever managements you have heard about, they all have sounded very pessimist on the outlook for Q2 and Q3, and these two are the best quarters for Indian earnings season. Be it festive season, be it marriage season, everything in the consumption driven themes all happens in these 2 quarters, and nobody is sounding optimist on these 2 quarters. So triggers for the market to go up from here, the stocks to have a significant buying traction, sustainable price traction looks unlikely to me. So more pen left, Neeraj, to my mind.
Well, yeah, the question mark will be when Rajiv Jain decides to speak to media after the numbers, and after that 41% AUM growth numbers. I think that they spoke about the 41% loan growth numbers that they referred to a few days ago. The question mark will be whether they are seeing the growth continuing or not. That's the key thing that you need to monitor. In about 60 seconds, we'll have the launch of Chandrayaan-2. Remember, carrying about 14 payloads, including 8 in the orbiter, 4 in the lander, and 2 in the rover. So it's a phenomenal achievement when it does happen. So we'll be bringing you live updates of that happening as well. So the markets may be going one way. We're hoping Chandrayaan goes the other way and does so successfully. The final countdown, of course, has already begun. It's India's most powerful launch vehicle, powered by an indigenous cryogenic upper stage. So that is the important. This is the first attempt to soft land on the moon and explore the uncharted South Pole.
The ground winds are too less.
Minus 1 minute.
When the ground winds are less, then the vehicle is designed to take much higher loads as well. Also, the upper altitude winds have been favorable, which means not much change from the earlier measured conditions. We always design the final rocket trajectory with measured winds, and thus the smaller wind variability means not much change from the design trajectory.
79 open.
Just T minus 33 seconds to launch. The excitement building up here on your screens. The close shot of the base of the Mark III, where you will see shortly the S200s igniting on the ground.
Minus 20 seconds.
T minus 18 seconds now.
अब आप ध्यान से अपनी स्क्रीन पे देखिए. अब आखिरी के 10 सेकंड बाकी हैं. अब मैं कुछ दिन के लिए अपनी वाणी को रोकूंगा. आप ध्यान से देखिए.
7, 6, 5, 4, 3, 2, 1, 0.
इस समय आप अपनी स्क्रीन पे देख रहे हैं 2 S200 रॉकेट.
Plus 5 seconds.
दोनों का प्रज्वलन हो गया है और उसने 640 इस टन वाले मार्क 3 रॉकेट नौगन को ऊपर की ओर लेके जा रहे हैं.
We have a lift off. We have a lift off. A perfectly normal lift off. S200.
First stage performance.
Okay, this has finally happened. ISRO's moon mission has been launched, and this is a historically monumental achievement, you would have to say. And we're going with the assumption, of course, a lot of this will be successful. It's India's second moon mission, launched from the Satish Dhawan Space Center in Sridhara, Kota in Andhra Pradesh. This is, of course, remember, a week after the liftoff was aborted due to a technical snag. But, well, this time around we've had. Now, Chandrayaan-2, from what I read, it's launched on board ISRO's most powerful launcher, as I said, the 640-ton rocket, which is GSLV Mk3, and it's been nicknamed Bahubali. Well, not interestingly, so that's the other interesting bit. But yeah, this is historic. And remember, I think by the course of the evening, a bunch of stories and updates, etc., will be there on all media platforms, because this is historic from an India perspective. So pretty interesting.
On your screens, Dr. Shivan, Chairman ISRO, flanked by...
Okay, so the launch has happened. Let's get back to the markets and get back to the conversation that we are having on stocks, which are doing quite the opposite, really, from what Chandrayaan-2 is doing, which is going up. A clutch of stocks moving down. Today, the real estate pack has been taken to the cleaners as well. Everything from an Indiabulls Real Estate to a DB Realty to a bunch of others. DLF may be holding out, but some of the others have certainly corrected, and Nifty Realty too is down about a couple of percentage points. The NHB instructions, Dharmesh, lead to further issues for some of the mid-sized developers who used to rely on this 595, 1090 schemes. With that out of the way as well, do you believe that at some point of time we'll either see distressed sales or prices coming off, and that might only rock the boat more for some of these mid-sized developers which are under some issues?
Yeah, definitely. Because this was the only route, most of the developers were, taking for last 2-3 years, because 595 and 90 kind of a schemes were doing for the bookings, and see, but this is from prospective effect. This is not from the retrospective effect. So this will give some relief as far as past sales are concerned. So I think, but yeah, going forward, real estate will be rocked more, and I think the prices will correct further, which will be a problem for most of the real estate developers.
Okay, let's address the battery makers, which were weak in Friday's session. And we also had Amara Raja numbers coming out on Saturday. Amara Raja today has been trading with gains of about 1.5%. And Exide, after touching fresh 52-week low, has seen some bit of recovery from the lower levels and currently trading with gains of nearly 2%, almost at the high point of the day. Dharmesh, globally, the lead prices have been softer, and also there were reports emerging how there's a price war now taking place between the two battery makers. And specifically looking at Amara Raja numbers, they have benefited from the benign prices. The margins have gone up about 300 basis points. Also considering they've not done too much on year-to-date basis, what's your view on these battery makers? Do you see some good returns can come in at lower levels now?
See, as far as top line is concerned, there was not any significant growth. It was a very muted single-digit kind of a growth which they have reported. Yeah, bottom line was up primarily because, as you pointed out, input prices were lower and the operational efficiency added to that. Given the kind of correction both the be it Amara Raja or Exide has taken, so some bounce back is there, but to my mind this is only a trading bounce back and nothing great about from a traction perspective. So for investors, we have advised our client that to stay away as of now for many auto ancillary and auto space. But from trade perspective, or trade of say 5-7% more from here, both for Amara Raja and Exide can be on. But I don't think there is any sustainable kind of recovery happening in the battery making space as of now, because numbers are still bad. Automobile sales numbers are still bad, and it is likely to be so for a few more months.
Okay, pull up the intraday chart of HUL. Remember, the earnings come out tomorrow, and there is some bit of weakness which has come by, and the stock's trading almost at the lowest point of the day, down 3%. Remember, in the last quarter, the key thing I believe to be watched out will be the volume growth figure, plus the commentary which came out last time about how the rural growth has panned out vis-a-vis the urban growth. Remember, last time the management had highlighted the rural demand moderated from 1.3 times that they've been witnessing to about 1.1 time. Whether that scenario continues in the current quarter, that will definitely weigh on the earnings. Last 3 months, the stocks corrected about 4%. And Dabur also, which came out with the numbers on Friday, the volume growth was pretty strong, which was over 9%. Stocks off the day's high, 421 is the level currently. But let me first get a technical check on HUL ahead of the numbers. Hemen, 3% lower right now. Would you take a bet?
A bit late. 1650 is crucial. If 1650 cracks for 2 days or a weekend, Navneet, I think we're going to lose 7% from there, because we've been hanging around at this level for almost 7 months in a range between 1650 1870, and we've come to these levels alternatively multiple times. There's a major distribution happening. Indicators are given sell on the monthly, on the weekly. I think it's just hanging on for dear life. The only thing in its favor is this is the 7th week in a row we are down from 1870 now to 1650. So maybe we take a final support at 1650 and give a dead cat bounce. But if and when we break 1650, probably after a bounce, I think it's going to tank.
Okay, Dharmesh, comment on some of these FMCG names and some numbers that have come out where we've seen stable volume numbers. Doesn't look like a fair bit of disappointment. In fact, on the contrary, a surprise positive. Would you expect the same from an HUL, and would you be a buyer in some of these names now?
I am afraid. I think HUL will set the tone for FMCG basket from when they announce the numbers. My own sense is around 4 to 5% kind of a volume growth and 1 or 1.5% kind of price realization growth. That is the blended relation. So net anywhere between 5 to 6% kind of a top line growth they will report tomorrow, and that is the scenario. No matter even if the PAT is higher on account of benign input price trajectory or operational efficiency, the stock will be punished more because rural and semi-rural, semi-urban areas, what dealer checks we have done, we have not got any satisfactory remark from any of them. So our dealer check says that the numbers will be bad for HUL. And Dabur may be an outlier because they have a very select category of products. They don't cater to the entire plethora basket which HUL has. So our own sense is stock price may correct further. Most of the correction has already been happened before the numbers have been announced, but I don't rule out 5 to 7% kind of a correction further from here. At that point, it definitely will merit a buy.
Okay, what did you make out of Interglobe Aviation's numbers? I mean, leaving aside whatever is happening at the promoter level, the operational performance is going from strength to strength. The stock now has crossed 1500, while obviously it has ceded some market share to SpiceJet in the recent data that we've got in terms of passenger traffic. But still, 48% market share versus 50% is not all that bad. Dharmesh, that's for you.
Is that to me?
Yes.
Yeah. See, the numbers were, phenomenal and the rock solid kind of a number. And management said that this quarter they were expecting a good set of numbers, so nothing wrong with that. And they also guided for a slow Q2 numbers, which is again very honest and candid kind of disclosure which they have given. If you set aside the promoter thing which has been happening, if you look at only on the merit of Interglobe Aviation, I think it would not be fair to say that SpiceJet will take away their market share or SpiceJet will do much better performance than Interglobe Aviation. With 48% kind of a market share, it's a huge market share which they are having, and they were the first mover to take advantage of any things happening out with Jet. But at the same time, the valuation looks very, at the peak of its level at 1600, 1500 kind of a stock price. It's already on the upper band of the valuation trajectory. So I would be a seller in HUL. At the same time, I won't be initiating a new fresh buy here. What would be the likely trajectory for me would be to stay put if I am holding Interglobe Aviation, and will continue to do so. SpiceJet, because if you look at the balance sheet, there's a remarkable difference between both the balance sheet, be it Interglobe Aviation or SpiceJet. So Interglobe Aviation is a debt-free kind of a balance sheet, very minimal kind of a debt, cash flows are robust, which will take care of any further pain accretion. So any correction, if it happens because of the market being falling or something like that, if one wants to be in aviation space, it has to be Interglobe Aviation. So a buy from my side.
We'll leave it at that. Dharmesh, thanks much for taking the time out and being with us today and giving us your thoughts. Appreciate your time.
Thank you so much, Neeraj. Thank you.
Well, stocks which are correcting, and some of these high PE stocks, one of them which is cracked ahead of its results is Page Industries. Again, rumor mills about how the numbers could be slightly wobbly. 3.5%, 19,413 for Page. Hemen, any thoughts on the charts? It's a stock that's corrected quite a bit already, but after stabilizing at the 20,000 levels, today correcting further, would you trade it?
Frankly speaking, it's slightly difficult. We've spent 9 weeks over here between 19 and 21,500, and now you have numbers coming in which one would not like to second guess. I think the OI has gone up. If I see this, it's almost 20% rise in OI, which is a bit strange. So there's a distinct negative bias, Neeraj, and no, I would prefer to stay away, because if 19,000 breaks after 9 weeks, on the hindsight, this would mean this was a distribution pattern, and we'll probably lose almost 8 to 10% from here. So I think it's at crossroads, but difficult call to make. But 19,000 needs to break if it has to go down.
Okay. So that's the verdict on Page Industries as we speak. HDFC is down 5% at 2187, and Kotak Bank ahead of its numbers is down about 2.5%, 2. So do watch out for both of those names in the session today. Yes Bank 89.90, Z Entertainment at 364 is trading at multi-week highs, I would presume. I don't remember the last time it crossed the 360 mark, or maybe it did briefly and then succumbed to some selling pressure. Do watch out for Z Entertainment as well. That's the other stock that is looking slightly strong today. Ajit, just one quick thought on Z Entertainment today.
See, Neeraj, though we are seeing rebound, but when it comes to media pack, the overall trend is still negative. So I would prefer using this rebound to exit in case if you have any long. And in fact, you can create fresh shorts also with stop loss of roughly around 2% from the current levels.
Okay, stay on, Jaman, as we slip into a short break though. Will the rest of the year be as laborious in terms of corporate earnings? That's what S. Krishna Kumar of Sundaram Mutual Fund had to say. Listen in.
Yeah, there are some downgrades in terms of growth in numbers. So we did start at the 26-27% earnings growth for FY20 about say 4-5 months back, and we probably are around to 20% or 18-20% kind of range. So I think this should stick for the year. Sans any meltdown in the economy, which I think is it's not even that you should build budget for. I think building in expectation of a recovery in growth into the second half of the year, I think we should be quite comfortable with 15 to 18% growth number. If it's even being conservative, I think a 15% number should hold definitely.
15%. So then would that justify the 17 times multiple that some of these brokerages have been putting on Nifty targets towards the end of the year, when they say that Nifty could touch about 12,900 odd?
Yeah, I think, if you do go into the end of the year, you would basically discount an FY21 number, which would be 17-18% higher than the number of 600 for Nifty earnings of FY20. So I think if you do build in discounting on the FY21 numbers, you would get to a far higher Nifty targets basically. So all we are saying is that, these are tough times, and there are are extraordinary provisions that one is taking on the books, and so you are seeing a lot of depressed earnings in many sectors still. So just going with the PE as an absolute number and looking at 16 or 17 times being expensive may not be the right view. But I think a lot more important is to see, is the economy getting back on track over the next 24 months, and if we do build in an 18% CAGR over the next 2 to 3 years, and then we should be fairly comfortable with the 16, 17 times PE number for the market multiple. Having said that, the broader market, even in the large cap stands at 10, 12 stocks, a lot of them are trading below, 14, 15 times. So also on the mid and small caps, you are seeing the indices are trading at about 14 and 13 times on a year ahead earnings. So there is a lot of correction that has happened. A lot of stocks are quite attractive. If you look at BSE 500 and look at all the mid and small caps, you will hardly find even a double dozen of them which are in positive return territory over a 2-year period. So I think that's the kind of meltdown we had in prices and readjustment of the valuations basically. So I think the markets are reasonably pricing in the current weakness and probably underpricing the growth forward.
Hitherto in India, we've had these broader end of the spectrum stocks correcting not because the world economy or even albeit the Indian economy has really collapsed. Individual accidents, you could argue it started with demonetization, the ASM framework, and then GST, and then the elections, and the NBA ILFS issues, all of them domestic. We still haven't faced an international issue thus far, and world markets are looking at substantially higher levels. What if they start to correct? Can this elusive small cap recovery get sidelined for a really long period of time?
I think what's happening globally in terms of softening growth in Europe and in US and the developed economies is actually quite positive for emerging markets. I think there's a clear differential of 2 to 3% on GDP growth across these economies and EMs, and clearly if central banks globally looking at data softening growth and low inflation currently, they are pumping in more liquidity, they are kind of looking to cut rates at this point in time. So these are situations which are very conducive for growth stimulus in the emerging markets. The central banks here will have a lot more leeway to go aggressively and cut interest rates because the currency is not going to take a knock because globally there is liquidity and rates are softening. So to the extent I think our real interest rates are still quite high, and there is a case to cut by 50 to 75 basis points on the repo and also try to bring down the credit spreads in the market. So I think cost of capital will come down, and that will be a major trigger for markets to kind of bounce off from the lows.